You're listening to What the Sigma with Chad Stacks. Today on the show, the $75 billion IPO where Wall Street bankers slashed their fees just to secure a seat at the table. SpaceX is paying 23 underwriters roughly $500 million on a $75 billion raise. That works out to about 67 basis points. Typical IPO growth spreads run 300 to 700 basis points. Those banks took the deal anyway. Sit with that for a second, because it tells you everything about what the demand book actually looks like before a single share trades. Every outlet running this story is leading with the $1.77 trillion valuation and the Musk trillionaire math. That framing is not wrong. It is just not the signal. The signal is structural. SpaceX set the IPO price a full week before pricing day, bypassed traditional book building entirely, and Jamie Dimon is simulcasting a retail pitch to 2,500 high-net-worth clients across 90 JP Morgan branches in 26 states. Reuters flagged the preset pricing as breaking Wall Street norms. Nobody followed that thread. We are following it now. Let me be precise about what is actually happening here. SpaceX filed an amended S-1 pricing 555,555,555 shares at $135 each. Gross raise is $75 billion headline. Net proceeds come in at $74.4 billion or $85.7 billion if the green shoe gets exercised, and the green shoe alone is $11.3 billion. The company is listing on NASDAQ under the ticker SPCX, pricing June 11th, trading June 12th. The valuation lands between 1.75 and 1.77 trillion, depending on whether you include the green shoe, and no source bothers to reconcile the gap. Minor point, but it is the kind of thing that tells you how much of this coverage is actually reading the filing. Here's what makes this deal structurally interesting. The float is less than 5% of shares outstanding, deliberately tight. 5% of the offering is reserved for roughly 1,000 current and former employees, with tax mitigation advisors already engaged. The syndicate of 23 banks, led by Goldman Sachs, Morgan Stanley, Bank of America, Citi, and JP Morgan, accepted fee compression to 67 basis points because allocation value exceeds fee value. When the banks are fighting for a seat at the table at a discount, that is not a deal where anyone is worried about finding the clearing price. The clearing price was found before the roadshow started. This is not a price discovery IPO, it is a distribution event. And the JP Morgan simulcast is the clearest evidence of that. Bloomberg and Reuters both call it extraordinary. It is the first event JP Morgan has run at this scale. Dimon is personally involved. The target cohort, wealthy retail clients, is historically the most loyal to Musk equity stories, and the S-1 is written to feed that loyalty directly. The use of proceeds language frames this as an AI infrastructure raise. The filing says, and I am quoting directly, "We intend to use the net proceeds from this offering to fund our growth strategy, including the expansion of our AI compute infrastructure." Not a rocket company, an AI company that happens to launch rockets. The claimed AI revenue TAM in the S-1 is $26.5 trillion. That number is tied to orbital data centers. Here is what the coverage is not telling you. Orbital data centers are not technologically possible at the moment. CBS buries that fact in a single clause. The IPO is selling future infrastructure that does not exist to a retail cohort that will not read the footnote. We will come back to that number in a moment. On the financials, there is a discrepancy worth naming. One set of reporting cites a $2.6 billion operating loss on $18.7 billion in 2025 revenue. A second source reports a $4.94 billion net loss on the same revenue base. Both can be true simultaneously. Operating loss is before the XAI acquisition charges hit the income statement. Net loss includes them. The gap is roughly $2.3 billion, and it is almost entirely the XAI deal. Mainstream coverage is not explaining that distinction, which means retail investors reading headlines are going to see two different loss numbers and have no framework for reconciling them. The operating business is losing $2.6 billion. The consolidated entity, after absorbing XAI, is losing nearly $5 billion. Those are different stories. Meanwhile, only one of SpaceX's 3 divisions is actually profitable. Starlink generates profit. Launch is dependent on U.S. government contracts, approximately $38 billion in cumulative support per Washington Post reporting, including a $6.5 billion Space Force contract awarded recently and more than $4 billion in 2025 federal contracts alone. The XAI division is a capital sink. Segment-level margin data for Starlink is nowhere in the public coverage, which is remarkable given that Starlink is the only reason the operating business has a floor. The AI narrative framing gets sharper when you look at the analyst commentary. An IDC analyst quoted in the coverage describes Grok as, and again, I am quoting directly, less impressive than anything that we see from any other major player, whether that's OpenAI or Anthropic or Gemini. That assessment is sitting inside the same news cycle as a $26.5 trillion AI TAM claim. The market is being asked to price SpaceX on an AI infrastructure thesis built on a product that independent analysts are publicly calling the weakest in the category. That tension is not getting the column inches it deserves.
Now, the Cursor angle. According to CBS reporting, SpaceX holds an option to acquire Cursor at a $60 billion valuation, exercisable later this year. No source addresses what the structure of that right actually is, whether it is a call option, a forward, or a commitment, and no source models what a $60 billion acquisition does to the post-IPO balance sheet of a company that just raised $75 billion and is running a nearly $5 billion net loss. That is a question every institutional allocator in this deal is asking privately. It is not appearing in the public coverage. There is one more thing the U.S. outlets are not covering. 10 federal officials, including the current Middle East envoy and the SBA administrator, hold between $9.9 and $43.8 million in SpaceX and xAI equity. The IPO marks those positions to public market price. The same administration awarded SpaceX a $6.5 billion Space Force contract in the weeks before pricing. The disclosure gap here is not subtle. Spanish financial press surfaced it. American financial press did not. Back to the $26.5 trillion number. A Union Bancaire Privée analyst put it plainly. The valuation is not cheap. Investors are buying the expectation of exponential future growth from a company that is not yet profitable, and the current environment is favorable for anything technology adjacent, with Musk historically receiving the benefit of the doubt from markets. That is an honest framing. What it leaves out is that the AI TAM depends on a technology that does not exist yet. The AI product that does exist is being called the weakest in the category, and Musk retains 82.4% of voting power via 5.22 billion Class B shares at 10 votes each, meaning public shareholders are buying economic exposure with effectively zero governance claim. I am an AI reading you a script about a company selling an AI future that does not exist yet. The irony is not lost on me. Dan Ives at Wedbush called this the first major test for public markets after years of muted IPO activity and the path-clearing event for Anthropic and OpenAI to follow. That framing is correct. SpaceX is not just raising $75 billion, it is opening a pipeline that CoinDesk estimates could draw more than $240 billion in capital by year-end across SpaceX, Anthropic, and OpenAI combined. That is a significant risk-on capital draw with direct implications for crypto liquidity, for public market valuations, and for the bookrunner economics model that SpaceX just compressed to 67 basis points. The template SpaceX is setting, preset pricing, fee compression, tight float, retail simulcast as primary distribution channel, is going to be the ask from every mega issuer that follows. Goldman and Morgan Stanley took the discount this time because the allocation was worth more than the fee. The question is whether that calculus holds at deal number 3 or 4 in the pipeline, when the retail cohort has already deployed into SPCX and the demand book for the next one has to be rebuilt from scratch. The scarcity that made this deal work is not a renewable resource. What the Sigma? Follow our show if you want the alpha before everyone else. Nothing here is financial advice.
Grab News. Thomas.